Oh no! Oh no! I muted myself and forgot to unmute. So, good morning, everybody. My name is Nev Kraguljevic, and I am beyond excited that you are here. Welcome to Money Matters episode, where we're going to be discussing a bit more about are we facing deflation or hyperinflation risks. As always, we are going to be streaming live on onedealaway.com/live. So make sure you join us there tomorrow in case you're not here today. And if you're watching on YouTube, well, you kind of missed the party. But you can still subscribe to the channel and still get information and news. So make sure you click on that subscribe button somewhere right below the video or maybe somewhere on the side. I don't know. All right, so let's get on with today's episode. All right, and good morning, good morning, good morning. It is 7 o'clock. We are a bit early, but hey, it's the early bird that gets the worm, and I am beyond excited to share with you kind of what's going on and what's happening in the world of economy when it comes to, well, your and my money. So yeah, let's talk about the retirement. You know, a lot of people have this expectation that when they stop working, that they're going to be able to retire, that the government is going to take care of them, that the Social Security is going to be there for forever. And I think for my younger viewers, I think we are all well aware that Social Security will disappear by the time we reach a retirement age. And who knows, you know, they may raise that to like 80 or 90 years by the time we all get there. So that's kind of where we are and what's going on. But I wanted to kind of talk about what's going on with the Social Security and the fact that costs have skyrocketed, but Social Security are not keeping up. So let's take a look at this article by CNBC. Social Security cost of living adjustments are not keeping up with those growing expenses. For example, someone who retired in 2000 would have seen their average Social Security benefit of $816 per month increase to $1,246 this year. However, to keep up with inflation, they would need $1,626, an extra $380 per month, the report found. So you can kind of see the cost of adjustment has been going down and slowing down. So if you are expecting that the government and the Social Security is going to take care of you, I have bad news for you. That is not going to happen. And this is the reason why it's incredibly important that you start educating yourself about money, about wealth, about investing, about preserving and growing your wealth in order to take care of yourself, not just today, not just 5 years from now, but, you know, for decades and potentially, who knows, even generation to come behind you. The group also predicts that the Social Security cost of living adjustment, or COLA, for 2021 could be zero. Yes. So this is an interesting piece. I wanted to share this particular chart here with you. The cost faced by older Americans on the rise. So you can see, you know, as you age, you know, the prescription and healthcare is probably something that you can expect is going to cost you the most. So, you know, prescription drugs, that went up like a lot. Medicare Part B, that went up. Oh, homeowners insurance, yep, that's up too. As is heating, food. Veterinarian services, you know, one of the things that a lot of people have pets for many different reasons. I am one of those people. Some of us treat them like kids, some of us treat them as pets, some of us have them as sort of an emotional support animal. But, you know, you got to take care of those puppies and kitties and whatever else you have. So, you know, that's kind of gone up. The Medigap average monthly premium is up as well. Total medical costs up. Real estate tax up, oranges up, you know, so the basic food stuff is basically up. And, this is one of those things that is very interesting that is happening. Now, the question is of the whole deflation, inflation, and that's really where I want to focus today. We have a lot of news and information to go over and cover. And there was a report from Atlantic that basically says we can prevent the Great Depression, but it will take about 10 trillion. And that sounds like a really large number, but we've been shocked at like 2-3 trillion that has been created to sort of try to support the economy and people in this crisis. But this particular individual is arguing that we need a whole lot more. And here's some of the reasons what the argument is. We've already done the 2 trillion. There is a proposal for 3 trillion that's, I think, still being debated and kind of fought over. And we'll see if that's actually going to happen or not. I mean, I've already reported that Trump is going to veto, or at least he said he's going to veto, even if it passes Congress. House has passed that we haven't received any news whether that is real or not. And I will be very honest and transparent to say that I have not checked it this morning to see if it may be passed overnight. So it's possible that it's happening, but we'll see. We'll see when that happens. Everybody will know it. But the question is, do we need to spend that 5 trillion in just 3 months, and does it need to be even more? And they're arguing that it's yes to all of that stuff, and it's very similar to what I have shared yesterday on the live stream with you, to basically say that it is necessary because of the slowdown. And here's a few different arguments that I'm going to be sharing with you. So it's a very independent, my thinking that is being potentially supported by some of the other folks. So it's not just me, it's other people saying it. So small business activity has plunged nationwide by nearly 50%. Scarcely 1/3 of Americans say that they are working because, roughly 40 million people are unemployed now. And next month's job report will likely show that for the first time since World War II, a majority of Americans aren't officially employed. In March, the U.S. passed the CARES Act, which was an important, impressive start, but it wasn't enough. And I have been talking about that that's not enough. That 600 benefit for unemployed workers will lapse on July 31st, and it's just simply not enough. And thousands of small businesses fail to snag those PPP funds. And now the state and local governments are also facing catastrophic loss of tax revenue from sales, income tax, and everything else. So they need money, and we've already heard those news. Now, preventing another Great Depression requires more relief. So for families, adding another direct payment to families in the range of $1,000, an extension of 600 unemployment insurance benefits, and measures for food and housing, rental, mortgage support, etc., total cost 1.2 trillion. Now, one of the things that I do want to point out right here is that one-time payment doesn't do much of anything, and I've already argued that point in previous episodes and previous videos that are all posted on the YouTube channel that you can definitely check, and I highly encourage you to check out, and just sort of food for thought. My opinion is my opinion. You can agree or disagree, and let me know in the comments and of what you think and kind of how you feel about the whole thing. But that's sort of what my viewpoint is, and it sounds like these folks are arguing the same thing. I actually think that the universal basic income will likely have to roll out, and it might not necessarily last for forever, although when we hear that there's a temporary something that comes out of government, that typically ends up turning into forever. And I do expect that is going to happen. That is going to have to happen. It's not something that they want. I don't think the government or the Fed actually want that to happen, but it will have to. All right, let's continue. The PPP loan forgiveness has not worked for many small companies. Agreed. Zero interest loan. So they're proposing zero interest loan to small businesses that they could pay back over many years. Total cost $600 billion. I actually, the part that is challenging with the loans, the first problem that I had with PPP that I still have to this date, and the reason that I did not decide to go for it and apply for any of those loans is because it's a loan. It's a loan. You got to pay it back. And if there's any misstep, and they don't even have the rules of how it's exactly going to pay back, so there's a lot of uncertainty. And whenever there is a lot of uncertainty and possibility or potential that the government could potentially, take advantage of the situation, they might. And it's not necessarily just the government, but it's also the banks. And, if you're saying, boy, Nev, you don't really trust the government or the banks, you are right. I don't. I don't believe depending on a third party to do much of anything. I do believe in becoming a sovereign individual and really keeping control over your own pieces. And so my problem is the way that I think about it is that you borrow money, which is fine, right? I mean, I borrow money for business. Of course I do. But when that dollar doesn't produce additional dollar plus, it always has to produce dollar plus in order to make sense to borrow. When you borrow money and there's no income coming back, how are you going to pay that money back? That's what the question is. And yeah, they're saying it's a forgivable loan, but you got to follow within a very specific rule sets that if you have a small misstep or something happens, the entire thing is due back plus interest. So that's the part that I have a problem with. The local and state governments, they're saying that the state budget shortfalls in the next 3 years could approach 700 billion. Federal government has to provide aid to states and local government budgets. Total cost half a trillion. My gosh, $500 billion to $1 trillion. Public health economy won't recover until public health crisis ends. More or less agree. Funding for mass testing, effective contact tracing, dedicated quarantine facilities, mass production of masks, and so on and so on. Total cost $200 billion. It's interesting that they are arguing that this particular thing, where they're saying this is a really important piece, but they are saying this should receive the least amount of money. I don't know how they came up with the calculations. I haven't been able to connect with them, nor have I tried, I'll be very honest, but it's an interesting article for sure. And then for the future, the last recession's miserable recovery showed that the congressional politics often slows down or entirely blocks urgently needed economic stimulus. Put stimulus on autopilot. I will agree on this one. The government is very slow to respond, and sometimes, they're quick to respond as far as like, yes, we're doing this, they pass it, like they did with the CARES Act, but then it took a month to roll the thing out, and some people are still trying to figure out. We are right now, what is today? May something? Where's my little mouse thingy? May 19th of 2020. This was passed in early mid-March. We still have a lot of people who are waiting for the relief and the checks and all of that stuff. When you add it all up, the $3 trillion already spent, the $3 trillion now required, and trillions more to accelerate the U.S. recovery, the total price tag for averting another Great Depression could be about $10 trillion. Now, they're saying that the number, of course, is a stunner, but the U.S. economy is $22 trillion, or at least it was before crisis, and because of the large and sharp drop, printing a lot of money to sort of meet the gap, to sort of fill this black hole, is what is needed. Claiming that there's no risk to the government spending any amounts of money over any period of time, that there's no risk, would be dishonest. First, there's inflation. The U.S. is dealing with the worst, very opposite problem, the risk of deflation. And I wouldn't call it risk. It's actually happening. It's real. And I'm going to show you another article where that shows sort of like a proof of what and why. The last week, the Labor Department reported that one measure of consumer prices called core inflation, which does not include energy and other volatile indexes, suffered its largest drop in the history of the statistics. Second, $10 trillion of economic relief and stimulus will dramatically increase U.S. debt, but with interest rates even lower than the expected rate of inflation, the federal government can essentially borrow money for free. Third, some might worry that higher debts today could augur higher taxes tomorrow. And I think that is possible, but they're saying well, I'd rather not pay today, I'd rather pay in the future. So there you go. This is coming straight from the Atlantic. Now, let's switch on to a different article, and I'm going to have some water. Okay. So you gotta hydrate, y'all. You gotta hydrate. You gotta work out. You gotta study. And this is the reason why you're here, why you're watching this channel, why you are subscribing to the channel, is because if you don't study every single day, and I study every single day, you are basically going to be taken advantage of by the situation. I always say, in every crisis there are opportunities and risks, and if you don't study and you don't understand, the situation will take advantage of you as opposed to you taking advantage of the situation. And that's why we're here. So this is an article, a blog from a different sort of view on things, and is it deflation or hyperinflation risks. And let me see if I can maybe make this a bit larger so that we can see what's on the screen, because I think it's easier to read if you can actually see it. So we think deflation risks are more imminent. I agree. Now here are some of the inflation arguments. Initially it was a supply shock. This is still dominating. Negative demand shocks in some sectors, which should lead to higher prices. This is the part where we're arguing inflation, right? Of whether it's going to be inflation or deflation. And so this is sort of what will cause inflation arguments. So the supply shock, right? The public and private debt are on the rise, agreed. Although, even though I agree that they are on the rise and have been on the rise, what we have seen is that because of the fear, because of what's going on, that many people who can are in effect trying to reduce their debts. They're paying that puppy off as much as possible. They're saving cash, and they're not spending as much, partially because they don't want to, partially because you can't even go out and spend it, right? So all of those are deflationary components and deflationary triggers. But anyways, if productivity slows due to, for instance, loss of know-how, profit margins get squeezed, which firms may offset by hiking prices, right? So weekly unemployment benefits are above the median of the lower percentile of income earners. This should lead to low-income workers demanding higher wages if they're hired, which is something that I have talked about. Fed's open-ended QE, meaning there is no limit, we will go out and do stuff, has resulted in its balance sheet exploding, and it fears we are not close to the end. So here is the QE chart that basically shows you this QE to eternity. So you will see we're kind of printing, we went back down, kind of slowed down, and we started to go back up, QE to eternity. So we'll see how that's play out, but it's a good chart. Why hyperinflation is not reborn. So another piece that people are arguing that we're going to hit the hyperinflation, and these individuals are arguing that this may not necessarily happen. Fed does QE, right? When the Fed does QE, this only increases the monetary base, not directly the money supply. The latter, meaning the money supply, is where money and cash are really created or quote-unquote printed, and what matters most is inflation. In order for the money supply to increase, banks have to lend to consumers and business. So you can see this is the total of what's been going on, so you can see it kind of going up. This is money in circulation, or currency in circulation, let me be accurate, and then the money multiplier. So it's kind of like looking at what's going on, how much people actually have money. So a lot of currency has been created. The problem is it's not necessarily reaching many people. A lot of it is stuck with billionaires who are sitting on cash, right? I mean, we covered yesterday of many incredibly intelligent and rich people. Maybe they're not intelligent, maybe they're well connected, so you could argue all kinds of points, but they're all sitting in cash. They're not necessarily investing, so money is not going into the circulation, and it's really that velocity of money, of when I have $1, I give it to you. You go out, buy, cake. The cake store owner uses Uber. The Uber driver puts the gas. The gas store owner pays the taxes. The government gives it to the local school. Like, right? That's the circulation. That's the velocity of money. That has slowed down and it's been slowing down, and that's actually what triggers inflation. But let's continue with the article. It is in fact monetary base that has skyrocketed, not the money supply, as the money multiplier has declined, which we can see on the chart right here. And it's an important explanation why inflation has been stubbornly low. So the money supply has spiked recently, which is agreed. And if you're interested to know what M1, M2 basically is and the percentage of GDP, there's a video that I have done that you can find on my channel that I've done actually on April 10th, to be exact, where I talked about what all of this stuff means and how it all plays out. A spike in the money supply is not unusual during deflationary recessions. The higher money supply is offset by collapse in money velocity, which is what we just talked about. The latter, meaning velocity, is the reason, the key to why should not expect inflation, meaning people are not going out, people are not spending money, we're not trading as much. So what they're saying is, in our view, there's no way hyperinflation will materialize unless money velocity at least stabilizes and, in my opinion, also picks up. This is not part of the thing, this is just my opinion. So here is this piece on money velocity that I just talked about. And you can see money velocity is this dark blue. And, it's been kind of like going back up and down, up and down. But look at this stuff. Like, it just went super low. And, we do expect that it might go even lower. Okay, so this is the CPI model, and it's based on the quantity theory of money. And you can see the core CPI has gone down. The proxy of quantity theory of money has also gone down. Like, everything you look at is going down, 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 except for the unemployment market and apparently the stocks. What in the world? Anyways, now they want to cover the deflationary factors. Some more simple deflationary reasons. Oil prices have declined, which we can agree, and they have negative effect on long-term inflation expectations. And here is basically the chart where they're talking about like the core CPI, the core goods, all of those different things, and you can see just about everything is going negative right over here, and this is the month-over-month percentage as annualized. But if we look at the year-over-year, it's still in the positive, although we're starting to see some of the negative turns. And of course, it affects the core CPI, core goods, core services, such as shelter, rent, and all of that stuff. And that's still over on the positive side. But I do expect and I do think that they might actually switch over to the negative. This is the long-term inflation expectations, and you can kind of see where things are going down, not up. And you can see that there's a strong correlation between the crude, right, the dark blue, and the inflation rate. So you can kind of see that it's pretty, it's not exact, but it does follow pretty well. We argued back in February that immediate supply shock would turn into a demand shock. This should lead to a plain simple negative demand pull on prices. And remember that demand shocks usually result in more sticky prices than supply shocks. So they're basically saying that, they are not necessarily expecting the prices to go up. They're expecting them to stay flat or actually go down. And that's a very typical piece of the deflation component, right? That money becomes more valuable, and in return, the prices actually, stay stable or go down. Prices will most likely decline due to significant negative demand pull from no economic activity. If there's no economic activity, what in the world can you do? Lower capacity utilization means less price pressure. Agreed. Wage growth. The April job report, this is an interesting one. The April job report, where average hourly earnings completely exploded, however, This was simply due to low income earners being withdrawn from the equation. So what happened is that when a lot of people got laid off and hit the unemployment numbers, a vast majority, first people that kind of hit that were obviously a service sector, but a lot of them are on the lower pay scale. So when you remove them out of that, then you have this sort of spike of everybody else who has a job, meaning that it's mostly, white collar workers, which tend to not always, but typically earn more. So that's why they're saying the data is distorted. A more accurate picture is instead given in, for example, the Fed's April Beige Book of NFIB Small Business Survey. Most agents cited expectation of wage softening and salary cuts. And the reason, and you can see the chart over here, but the reason for that is because, as a business owner, if you get less money, that means, in the business, because of less business, right, like less customers kind of going in and buying stuff and doing things, well, of course, you're going to earn less money. And if you're drawing salary from that, you have to draw a smaller salary and pay less for your employees. So, of course, I think that makes perfect sense to me. Wages are normally linked to the service sector, which we just talked about, which has by far been hardest hit. Services, which constitute around 75% of CPI basket, may therefore overtake goods' role as the disinflationary force in the coming quarters. So you can see the core services, and you can see the decoupling that kind of happened over in the 80s, and then the service sector is actually what exploded, but the core goods kind of sort of went up, and then it's been staying mostly flat for decades. So that's an interesting piece. Another factor is the dollar, which has appreciated. We all know that. The stronger dollar puts downward pressure on import prices. And you can see that we've been experiencing this. President Trump has been talking about it for forever. Whether you agree with it, disagree with it, it's just kind of where it is. There will be some structural disinflationary trends. These involve slower population growth, which is because, we have less people and people that are here on planet, because everything is so expensive and raising a child is incredibly expensive. Many people are choosing consciously not to have kids, or if they have a kid, they have like a kid. We no longer see like families of like 5, 6, 7, 10 kids. I mean, it happens, but it's so rare. I mean, it's super rare that there's actually TV shows about it, we see that. We saw that in Japan, where people were not getting married, they're not having kids because they can't afford any of that stuff. And I think, some of that stuff is happening here in U.S. And, we also have stopped immigration stuff. So when you cut sources of how people enter the world or the economy or the country, of course, the population actually ends up dropping. More globalization over the past decade has been disinflationary force, although I do expect that maybe we'll see some localization happening as opposed to globalization. So I can kind of see where some of the global stuff, people are going to start drawing some of the, not everything, I don't think everything will be, but some of the stuff will become a bit more localized. So in conclusion, the bottom line is that we see deflation risk as a much bigger concern for the Fed than hyperinflation. I do agree, at least short term. And when I say short term, I'm talking like 12 to 18 months roughly. Again, I could be wrong, they could be wrong, but the evidence, that's what it points. A significant downward price pressure in the next few quarters. Whereas the last decade was one of low inflation, the 2020s may thus, in a worst case scenario, end up being the decade of no inflation. That's that depression piece that I have been talking about, that I believe we have entered, and we just can't call it. We just don't know it. Maybe we know it, but it's not necessarily something that's talked about. It's sort of the fear of we don't want to go into depression, but I think that that is what is happening right now. So what would it then take for hyperinflation to materialize? If the Fed broke the taboo of conducting real money printing, i.e., not using current pseudo deficits, debt monetization, but financing deficit by creating the treasury account at the Fed, which they might do and they have been talking about potentially doing, this would be the true Freeman helicopter money. So there you go. That's sort of the inflation deflation component. But I want to switch really quickly because many of the folks on the channel also like to invest money. And in today's episode, I do want to cover and talk about, real estate and what's going on in the real estate. So I have a few different articles that I want to share with you. And so let's go and jump into it. And again, you can't really see that. Let me see again if I can zoom in just a little bit so that we can see this bad boy. Another real estate crash is coming. So because of the what's going on, that there are some happening that before the Fed has stepped in to kind of help with the mortgage crisis and so on. They're saying here the step isn't stepping in to bail out the real estate sector, and the big losers are said to be ordinary households. And I absolutely agree with this stuff. So since the start of the crisis, Federal Reserve has won admiration from many quarters for the pace and magnitude of its intervention to stabilize financial markets. However, they have taken crucial steps to resuscitate the liquidity back in 2008, and they started pumping money. But here's the argument: little attention has been paid to one very peculiar aspect of Fed's action, namely its relative lack of intervention in the private label mortgage-backed bonds that come without either implicit or explicit U.S. government guarantees. So we have this this whole thing kind of happening with money being printed, but a lot of it is going towards the stocks right now, and trying to kind of create liquidity there. And what we're seeing within the mortgage is that forbearance, right? Like, it's not forgiveness, it's not moratoriums, it's not any of that stuff. It's more of the, put a pause and you'll pay us later at maybe higher rates, or we'll restructure or whatever. And it's affecting people. It's affecting by lower scores. It's affecting by inability to do much of anything else. And so, many people may have to do some of the additional components of refinancing or selling or dumping or any of that stuff. And, they're basically arguing that, we can see a big problem happening. The Republicans and the Democrats know that whoever pushes first for massive bailout package for the real estate sector will be charged with implementing a deeply unpopular policy. In turn, this will provide the opportunity for the other sides of the aisle in Congress to fulminate and masquerade as the outrage tribune of the people. They are... here's the piece buried. This is an interesting statement. Buried among the many provisions, there is $75 billion in mortgage relief and $100 billion in rental relief for low-income earners, as well as the ability for all borrowers to claim forbearance for up to a year. The bill would also allow for Fed to lend mortgage servicing companies and directs to set up new emergency lending facility to owners of rental properties. The bill also composes tax cuts, primarily benefit for the rich, bailouts for corporate lobbyists and dark money in politics, as well as subsidies for health insurance companies. So at the best, the bill is a little more than blackmail of the working class into accepting political measures. So here's the part where they talk about the shock to the market, and part of it is that there is going to be a lot of commercial businesses that are going to go delinquent because of lack of trade. And yesterday we actually talked about that many companies, many very, very large companies are filing for bankruptcies, and they're going through mostly Chapter 11, which is the sort of restructuring of the debt. But there are also some of the places that are talking about, filing for complete liquidation, like we are going out of business, we're never coming back. And so, but a lot of those places are renting. Well, if you are an owner of that particular building or mall or whatever, and all of them start withdrawing because they can't pay, they're going out of business, that means that that particular owner of the building, the landlord as they call it, is not getting money. Well, if they're not getting money, they can't pay for the mortgage, right? If they can't pay for the mortgage, it's that knock-up effect. And so, as an owner, if you cannot pay your bills, then you might have to go restructure or go out of business yourself. Water time. Okay. Now, this pressure is basically going to be on the rents and have already accumulated. And so this really kind of talks about that, with the unemployment and everything else, that, if people are unemployed, they're not able to pay rents. If they don't pay rents, I can't pay mortgage. If I don't pay mortgage, a mortgage service provider doesn't collect the money. If they don't collect the money, they can't pay the investors. If the investors don't make money, right? Like, it's that knock-up effect, and I've actually done a video on all of that stuff, explaining the whole thing to you, and to explain kind of what's going on and why there's a problem. I'm also going to switch over to this particular article from S&P Global, and they're talking about the economic research. Government job support will stem European housing market prices to fall. And I've watched that there was something in the news, not in the news, in the newspapers, my apologies. They have talked about the European housing markets already started to drop all over, from Germany to Ireland to Spain, Italy, all over the place. The only one place that actually the price per square foot or per square meter, as they actually do it over in Europe, Vienna was the only place that it went slightly up. Everywhere else it started to go down, and that I really expect all of that to happen. Here's the really interesting piece, and again, let me see if I can zoom in and make sure that we can all see this chart a little bit better. So here is kind of what they're seeing. I like charts. As you know, I like charts because, when you have a lot of words and stuff and a lot of data that just kind of comes in, it's really hard to understand of what's going on. But when you have a chart, you can actually see the trends of what's going on. So here we see right here in the 2017 and 2018, right, kind of the history piece, 2019. And now this is sort of the prediction of what they're expecting, that, right, this is the forecast, this is what the F means, that it's going to go down, and then it might kind of start picking up in the in late 2020s and into the 2021. So because we're right now in May and we've seen some of the drops, I do expect that actually drops are going to continue for a little while. And so I do believe that if you are an investor and if you are looking to go into real estate, you don't want to buy up here, right? You don't want to buy necessarily here either. You want to buy somewhere around here. So paying attention to the drops in particular asset price is that's where you want to go and buy. And so your initial reaction, your emotional reaction is going to say, ooh, I don't know, man. Like, this is really scary. Everybody's selling. The prices are dropping. I don't know how low this is going to go. And I don't want to participate. But when we see the market prices kind of start going up and they're reaching things and everybody's jumping in, this is where FOMO starts kicking in, and then we buy. That's the wrong time to do, okay? So as an investor, not just for real estate, but this goes for every market, from stocks to bonds, to gold, to real estate, to oil, to Bitcoin and other cryptocurrencies. You want to buy, you want to understand, obviously, the underlying fundamentals. You understand where we're going and why. you want to understand the sort of what is the trading channel. And trading channel is basically, when you take a look at the sort of the ups and downs of the thing, you want to take a look at sort of what is the channel. Is it going up? Is it going down? Is it kind of going sideways? And if we were to apply that right over here, right here in this part, we can see that the channel, right, is going down. I mean, look at it. Then over here we can kind of see the channel is going up and maybe flattening. So, but we don't really know what exactly is going to happen. What they're talking about over here is you can see all of the countries, and they're basically expecting for everybody to basically drop except for one market potentially. And I believe that this is my gosh, they put Germany and Switzerland in a very close colors, and so it's hard to tell, is this Germany or is this Switzerland, because they color-wise look pretty darn the same. So I don't know, you're gonna have to inspect it alongside with me. But there is one particular country, Italy, in this particular chart that will drop, and they're saying that puppy is not recovering. So something to pay attention to. This is the kind of the European housing market forecast. Oh, and here we can see of which one they're expecting to actually not dip as much. And okay, it's Switzerland. Here we go. It is Switzerland. So this over here that we've been looking, this one little guy that might not go negative, that's actually Switzerland, not Germany. So they do expect that everywhere is going to drop. So Germany, it's a little bit, I mean, look at Ireland, 3.5%, Spain, 3.2%, UK, 3%. But, when they talk about the recovery, this is where Italy is. They're expecting Italy to be at negative 3%. But then, the recovery is going to be like a 0 or 0.5, which is why they're talking about that it might necessarily recover as much. So this is from spglobal.com, and I do highly recommend that you go in and read the whole thing right here, which is going to give you a whole lot of information of what's going on in Europe, because we have audience all over the world. Some folks are over in Asia, we have folks over from Africa, which is exciting, Australia, a lot of people from Europe. Sorry, the air went the wrong pipe, as they say. So I'm one of the very, very few people that you will ever meet that can sometimes choke on air. So there's something embarrassing about me you get to learn today. But we've seen kind of, here's what's happening. And so they take the GDP and, it doesn't look pretty. Look at this, y'all. Everywhere they're expecting that the GDP is going to drop. And I agree. And I think that this actually might be on the lower end of things. I actually expect this is going to be much higher, and the reason for that is, when you shut down entire world, like everything stops, we're talking like, I wouldn't even say trillions, I would say quadrillions of dollars or euros, however you want to convert it, that is just not exchanging hands. There's nothing happening, and so of course things are going to drop. But they do expect that things are going to pick up, relatively speaking, nicely, and that it's here's the inflation component, right? So they're expecting right here as well, similar to what we talked about earlier, that they're expecting deflation. When you have super low or negative inflation, like for example Switzerland, they're expecting in 2020 that it's going to go negative inflation wise, and I would actually argue that that's probably the case for everywhere else. This is interesting. A lot of times we focus on unemployment rate when it comes to United States because US is very good about reporting those things very publicly, and but it is important to look at the rest of the world. And so let's look at the unemployment rate. And here they're expecting relatively low unemployment rate, which is really shocking to me. Spain looks like Spain and Italy seem to be kind of the highest. But I don't know if this is going to be true. Again, I could be wrong. In U.S. we're expecting the unemployment rate to be, in the 20 to 30 some percent, which is depression level unemployment, and yet Europe is saying, yeah, we weren't gonna experience as much. But I think that this, again, a super conservative way to look at it. I think this is gonna go higher. I do believe that we're going to see unemployment even in Europe or all over the world that is going to hit double digits all over the world, all over the globe. So 10-year government bonds. So here's kind of what you can expect. And a lot of it is basically zero or negative, except this guy over here. What is this again? Oh, that's Italy. Interesting. So Italy has been really severely hit by the whole crisis, yet they're expecting that they're going to be able to give a positive return. I don't know how that's possible, and maybe that's the reason why we're seeing this sort of fight between the North and the South in Europe, and Germany having really big issues with Italy, and it's very interesting. A lot of people are talking about potential breaking down of Europe and European zone and Euro itself, because it seems like every country is kind of in for itself. So let me know what you think. What are your thoughts about what's going on with the Europe? Are these numbers accurate? Are they not? I'm not in Europe. I'm in the United States. So it's kind of hard to be able to understand what's happening, halfway around the globe when you're not there. But, I know they have been in a shutdown as well, and I know that things have been rather challenging, and you can't travel from one country to another. They open up the borders. It's similar to kind of what happens in the United States, where you can live in, say, California, but you can travel easily without passport, I think, to Arizona, right? They're connected. They're right next to each other. Or you can go from, Pennsylvania over to California, just, a flight. It's a long flight, but a flight nonetheless. But and even now with the shutdown in United States, you can still go from state to state. You don't need permission and that kind of stuff. They will say you got to quarantine or whatever. Different states have different rules, but you can still travel freely. Europe is very interesting because if you live in France, for example, you can't go to Switzerland. It's shut down. Like, they actually closed the borders. So it's very interesting that this particular crisis has highlighted something very important in Europe. And that is that every country is in for itself right now, which is what's causing a lot of these pressures and beliefs that many people have that, they're going to shut down and break down. So it will be an interesting development to kind of see what's going on. But, again, let me know what you think. What are your thoughts? Is that a good thing? Is that a bad thing? Have you been expecting it? Is that like a surprise? That's kind of where it is. So, this is kind of where we are and what's going on. So I hope that you have enjoyed the particular show. And again, if you're watching this on YouTube, well, you missed the live show. And while, yes, you will still get the news, sometimes news is important to get right there on the, before anybody else. Because in order to win, sometimes in markets, often in markets, you have to be early. And this is the reason why we do early show, 7 a.m. every morning, onedealaway.com/live. And watching before everybody else means that you have the information before everybody else and you're able to take action. Because while other people are sleeping and snoozing and making breakfast, and who knows if they're making breakfast, you are learning, you are engaging, you get this sort of extra benefit to be able to monetize on what's happening and how to position yourself the best. So if you missed the show, my apologies, but join me tomorrow live at onedealaway.com/live. Thank you for watching. Again, excited for you to kind of join. Hopefully you like this stuff. And even if you're on YouTube watching this, subscribe there. If 7 a.m. is too early for you, which, give it a shot. See what happens when you start getting up early. A lot of things will change for you. But thank you for watching. Until next time, stay forever money blessed. And do remember, you are only one deal away. Bye, y'all.